This lecture is based on John Ho's original textbook on options. It's chapter 11, Model of the Behavior of Stock Prices. I think we will have a copy of that chapter online available for you to download. Any variables whose value changes over time in an uncertain way is said to follow a stochastic process. In this lecture, we are looking at what the dynamic behind a stock price changes using the stochastic process to explain it. Now, there is one book pretty famous among investment community. It's by Burden McKill, a Yale professor. That book. In that book, he's talking about among all the investment theories, there are three types of theories. Number one is so-called firm foundation theory. It is used by, for example, like CFA. You study financial analysis. You think a stock price is directly associated with its cash flow, so-called intrinsic value or present value of a future expected cash flows. Those are called firm foundation theory. In other words, that school of thinking, the stock price, it's just the present value of all expected future cash flows. There's one school of thinking, particularly held by many of those analysts. The second school of thinking is more of like a trader's belief. The price is whatever the buyer or seller will determine. He actually used an example of beauty contest, beauty pageant. Who is the prettiest one is totally depend on the judges. So in order to try to figure out the price, you need to think about, instead of what your personal preference, who is the prettiest one among those beauty pageant, you try to guess who the judges will think is the prettiest one, and you vote that. So this is called the castle in the air theory. Basically thinking about the stock price is whatever the market determines. The trader belief is more of like a behavior finance school of thinking. The third one is more academic. It's based on the efficient market hypothesis. It's by Eugene Fama at University of Chicago. It's basically saying that the stock market actually follow a random walk. It's the market basically just bring up whatever the information into the stock price. So there's no way you can predict consistently with the market. Now, that third school is mostly the bigger believer, I think, in academics, because you can easily to test all the theory by empirical studies, and most studies seems like support the efficient market hypothesis. We'll discuss this one later. Now, before we move further, up to now, what we study pricing formula are basically deterministic. A good example is the constant dividend model used in equity evaluation. We argue that stock price is equal to D1 next dividend divided by R, which is a discount rate for equity, minus G. G is the dividend growth rate. So you're giving me that three parameter, I'll give you the value. Those are typical deterministic. Most linear. Give me input, I'll give you output. However, in stochastic model, we're going to study For example, the Black-Scholes option model is based on probabilities. In the pricing formula, you have to use the probability to estimate the chances for that value or cash flow, what the value is. So the stochastic is a more sophisticated way compared to those deterministic model. And we are going to try to prepare you to study that. It's much more complicated. All right, let's move on. So some people think that random walk seems like to exaggerate the stock market. You think it's irrational, but as a matter of fact, actually, it's very rational. Let's trace back the early study on random character of security prices. The early study we can really find out is by a French economist by the name of Louis Bachelard. His dissertation published in 1900, very early one. His study basically is based on French commodity futures market. He found out the speculation is futile. As a matter of fact, he said that you can flip a coin. 50% chances you get a tail, 50 chances to get heads. And tomorrow's price, the futures price, the best bet is today's closing price. He's using the theory called a fair game. So the fair game, in other words, you might overprice or overvalue or undervalue. The chances are even. So in that case, the expected value is 0. A fair game is the expected value equal to 0, but the chances should above or below are the same. It's the fair game. Now his study actually now we find it's very, very good one, but at that time it's considered it's kind of a strange theory, so nobody take it too seriously. Then in late 1959, there are two studies. Actually, one of it is done by a non-economist, I think a physicist, by M.F.M. Osborne, I think. One is by Harry Roberts. He showed the actual stock price is quite random. You cannot really predict. That is pretty interesting. Let me just show you there an example I copied from Bodhi's investment class. We just took it last semester. They're basically arguing that it's when you're looking at the stock price, the history stock price, it's possible to perceive it has certain patterns. But in reality, it's not. The pattern is just random pattern. That is what the Harry Roberts did. When Harry Roberts did his study that time in early 1954-55. Oh, looking at it's in 1956, as a matter of fact. He downloaded the Friday closing price from December 30th, 1950 to December 28th, 1956. In other words, they are looking at 52 observations, the weekly closing price of Dow Jones Industrial Average. And he plotted with computer. But he also using the random number generating function. In other words, let the computer generate 52 random numbers. When he left his office, when he came back to his desk, he get confused to see which chart is based on the true market data and which chart is based on random number. Now here is from his article, Stock Market Patterns and the Financial Analysis, published in March 1959, Journal of Finance. The left one, A, is the true level of Dow Jones industrial average. On the right-hand side, panel B is a random number, generate function. So you might say that there is some kind of up and down theory. On the left, the TV announcer will say, well, we have the certain situation patterns. But on the right-hand side, the chart actually is generated by the computer, a random number. Those are price levels. Now you can calculate the rate of return. The next chart is the rate of return. In the rate of return, the left-hand side is the true market changes, and the right-hand side is the random number general function. So you really cannot distinguish which one is which, even using statistic testing to see if there is a pattern you can look at it. So this is what the Harry Robert did. The same year, we have a physicist publish a paper talking about the stock market with what kind of a Brownian motion in physics. As a matter of fact, he is looking at under the microscope, looking at some kind of dead pollen in the liquid, and the dead pollen will move due to molecule shock, zig and zag, zig and zag. No directions. No predictable directions. But the magnitude of the deviation is a function of time. In other words, the longer the time horizon, the larger the variation. That is called a Brownian motion. And Osborne found that the MFM found the stock market have those phenomena. We will study further on that part. But among all those previous studies, the most important one is by Professor Eugene Farmer of University of Chicago. His seminal paper on the theory of efficient market theory. In other words, he said there is a weak form efficiency, means you cannot consistently beat the market based on historic price, or semi-strong efficiency. You cannot beat the market using consistently beat the market using public available information. And a strong form efficiency is all the information. Obviously, that is not true. Now, when you're testing a hypothesis, you can never prove the hypothesis is absolutely true. The only thing you can do using empirical data is you cannot reject those hypotheses. And his weak form efficient hypothesis, which is in most cases people consider U.S. stock market follow that, claim that the rational behavior of investors will make the stock price move to weak form efficient. In other words, the price reflect all information available. So next day's price, the best estimate of next day's opening price is today's closing price. Now, this is when you think about those theory or those empirical study, it's very important. It's based on those theory, particularly academic study on the randomness of stock price. It's coming with the Black-Scholes model. Now, actually, we add Robert Merton to it, right? He also independently developed his model, very similar to Black-Scholes model. So, in order to study option, we need to looking at the underlying asset behavior, stock price, which is the source for all the volatility. That's why we need an option based on the underlying asset. Now, in order to study that, let's first just repeat what Henry Robert did. But let's do a simple one, a relatively simple example. Let's throw a coin, just like Bachelet did. Consider through a fair coin, you have 50 chances to get heads. You have 50 chances to get a tail. So when you threw one, you record it. Is a heads or tail? We're using 1 to represent the heads. We're using 0 to represent the tail. We know the probability are equal. Now let's assuming initially there is a stock has a value of 100. For next period, the stock either jump 10% or drop 10%, depending on heads and tail. So in our simulation, we're assuming the heads, if it's 1, is growing in 10%. Now, I put a the simulation. I already did it in simulation online, so you can download, do it yourself. Okay. Now, so here's the inputs. The heads row. Okay. Now in column E, you either get heads or tail, which we are going to using. We're going to use the random number generating function, which is equal to equal sign RANDBETWEEN between 0 and 1, which just throw a dice, either give you 0 or give 1. The chances, since it's a random number generator, either 50% 0, 50% 1. And then you record that. So my formula in E5 is equal to RANDET, random between 0 and 1. Then copy the whole thing along. I'll do like 100 times. Okay? Now, here's our model. In E5, my model said that equal, if you put an equal sign, then Excel knows this is a formula. If the E5, if E5 equal to 1, the outcome of the coin tossing is 1, comma, F4, the previous stock price, times 1.1, you grow 10%, comma, otherwise, the third situation, the second situation, it will be F4 times 0.9. So you just key that formula in, then you copy 100 times. You have that. Then you plot it. Now, why I'm using this model? I want you to do a simulation. Do a random throwing your dice. Within this model, since I'm not freezing all the cells, in if you're using Microsoft Windows, you hit function key F9, do the recalculation. Since I'm using the the Mac version, I have to hit Command equal sign. That's my recalculate. Now, pay attention to the graphic. I recalculate. So every time when I recalculate, the computer threw dice, threw coin for me. Consequently, I'm going up, 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 or going down, down, down. Now you see, it show you all those. No, it's too fast. I'll do it a little bit slower. So every time when you hit, oh, I hit the wrong one here. Sorry. Let me going back. Hit wrong one. So Command equal sign. So you recalculate. You throw the coins, you toss in the coin 100 times, and looking at the sequence of the price movement. Do you see that? Right? Let me hit once. So in this case, right, you have tail, heads, tail, tail, heads, heads, tail, heads, tail. No, little situation. Now this is a easy simulation of the randomness. I want you to repeat this to have a visual impression as for what the randomness was coming from. Now, I'm not saying those look exactly like stock market, up and down, but it do give you a feeling as for some kind. It seems like it has some patterns, or sometimes we find the stock market have some kind of reason going on. Now, you said, oh, this market, for example, now we say it peaked at a certain point, then economy contracts, going down, going down, going down. Right. I want you to repeat, download this software or create your own, and using the simulation, play with the simulation, have a visual impression as for what the randomness look like. Here's just one example we have. Let me go back to my slideshow again. Here I'm just make a copy it. The command for coin toss is random between parentheses 0, 1, comma. Okay, it's pretty straightforward, and you can repeat this one at your leisure time. As I say that, a stochastic process is dealing with uncertainties. Another word for stochastic is also called probabilistic. It's based on some certain distributions. Now, usually the data we're dealing with there are 4 categories. You're dealing with a function of time. The data is a function of time. Is a function of more underlying variables. Now, it can be discrete time or discrete variable. A good example, we're using coin tossing. I say that represents every month, right? Equal month, every monthly return, or every week. And the discrete variable can be like 10% up, 10% down, $1, $2, $3, not in between. But on the other hand, you can have the time discrete, looking at a daily or an hourly, but a continuous variable. A good example of this is, for example, is modeling a phone call. You're looking at like an answering desk. We usually modeling a computer lab answering desk. The pattern is the people might follow some kind of distribution, like let's say Poisson distribution for certain situation, or follow a normal distribution or gamma distribution. It depends on continuous variable, etc. Okay, so they calling any time, but you're looking at is every minute to see what the pattern will look like. So, for example, at a certain period, peak, at a certain hour, you have a most calling will come in, then you need more staff to do it. Time continues is the minute by minute, even second by second, but the variable itself can discrete. Now, as for what is a continuous variable, the best example I can use is thinking about the water level behind a dam in a reservoir. The water will not jump. A jump is indication it's a discrete, but continuous. It can be very fast or can be very slow. So we will say a continuous variable is thinking about is the water level behind the bar, behind a dam. But for our study in option theory, we assuming the fourth occasion. What is fourth occasion here? Is the continuous time and the continuous variable. Although in real life, we see is discrete time and a discrete variable, because let's say stock price can be the minimum cannot be less than 1 penny, isn't it? So incremental was 1 penny, 2 pennies, 3 pennies. But we assuming, particularly in the literature, we assuming it is a continuous time and a continuous variable. For many reasons. One reason is mathematical consideration. Because in continuous variable, we can conduct calculus. If discrete, then you have a jump situation. It's hard to do. For example, the interest rate used in option pricing theory, we are using continuous compounding. Remember, the e to the power of x, the continuous compounding, instead of using 10%, we're using per year, we're using continuous compounding. It's almost like a daily compounding. A good example here, k times e to the power of negative RT. K is the exercise price or strike price of option. E to the power of negative RT is continuous compounding. Here is a discount, because negative R, you divide it. Negative R times time to maturity. By the way, here T time variable are always in unit of year. Okay, for 6 months, 0.5. Okay, 3 months, 0.25. You can use the months divided by 12, right? The second equation I listed here is the futures price. Futures price is equal to spot price today increased at risk-free rate R, interest rate R, time to maturity, right? So those are always using continuous compounding. Later, I will show you why that's so important in option theory. We do not use discrete. So we're assuming the time trading every minute, and the price will increase is very, very tiny. Particularly in time, we call we take a limit. We say it's so tiny. Let me show you an example. Later I'll show you an example. As for when you adjust the time interval, it becomes tiny. It looks like a continuous. Now, stochastic process is a general term. There's one type of stochastic process called Markov process. It says a random variable, its future movement, depends only on where you are, not the history of how do you get there. That is typical called memoryless. No memories. How do you get there is irrelevant, but it depends on where you are. Those are called the Markov process. Here we assuming that stock price follow the Markov process. Okay, its future does not depend on where you're coming from. It's where you are. What is not history. That's similar to Eugene Farmer's argument, because the current price basically reflects all the information. The assertion that it's impossible to consistently beat the market, to find the trading rules based on past historic information. If you cannot do that, then you cannot reject the weak form efficiency. In other words, technical analysis does not really work. So that's why people arguing the Markov process for stock price in that case is clearly consistent with the weak form market efficiencies. Okay? So the market is efficient. It's important because stock price basically reflect all the information in it. Okay, that before that, people might argue they find some pattern, etc. But farmer's argument basically is meaningless. You don't need really looking at. There is no pattern in it. Right. Now we need to go with a little bit of mathematics here now. Let's looking at the random variable z, which the value will change continuously, but the change will happen in a small interval, delta t. The Greek letter delta means change. Delta t means t1 minus t0 or t2 minus t1, the interval delta t. Delta t can be month, week, day, hour, seconds, minute, seconds. But since it's a function of time, so for that short interval, small interval, delta t, the change of z is delta z. Now, if I'm using delta, means I'm talking about discrete variables. Okay. There are two conditions. If you meet two necessary conditions for a random variable to be qualified, called Wiener process. Number one, the change of that variable z, delta z, is equal to epsilon times square root of delta t. Epsilon is a random variable with a standard normal distribution. Now, the theta here, the first letter here, 0, is a mean value. 1 is a standard deviation, though this one we call a standard normal distribution. So the epsilon itself is has a expected value 0, but have some kind of variations. But times square root of dt. So equation 1 basically say that the change of that variable is equal to epsilon times square root of delta t. Number 2, the interval, different interval, the value of delta z for any two different non-overlapping period of time are independent. The correlation between delta z1 and delta z2 are equal to 0. Now those are we call Wiener process, a specialized Markov process. So the delta z, the mean is 0. The mean value is 0. Now remember earlier I said it was through a coin. The mean value is 0. But you have 50 chances plus, 50 chances minus. You have equal distance, 0. The variance here, let's look at the variance. The variance here is, since each time the delta z are not non-overlapping, dz is independently, no correlation in it. So the variance rate is t, total time. Is the change in variance to equal time. In standard deviation for that Wiener process, therefore, is the square root of the variance t, square root of variance t. In Markov process, changes in successive periods of time are independent. Mathematically, we call it delta z is IID. The random variable delta z is independent, identically distributed. Independent, identically distributed. IID. That means the variance, sigma square variance, are additive. You can add small changes, time, because the function of time. You add the time together, the total time, the variance, is t. Now we can have standard deviation of take a square root of t. This is kind of unusual, square root of t. In other words, the longer the period you observe, the big change you are facing. Remember the Brownian motion? You're looking at hour by hour, give you more zigzag than, let's say, minute by minute. But, however, the standard deviation itself is not additive. Okay? Is it because the variance is? Now, up to now, we are talking about is discrete. We're thinking about like hourly, every hour, or every day, every hour, trading day. So equation 11.1, the change of that z follow Wiener process equal to epsilon times square root of dt. And that one show you the Wiener process. But we let the delta become so tiny from day to hour, hour to minute, minute to seconds. Let's approach to 0. Now we have a continuous variable dz. D here, if you're looking at the d, which represents change, means infinite small time interval. Now I think a continuous. In other words, we're using d. If you're looking at d, it's a continuous. If you're looking at the delta, means it's discrete. Okay. So delta t become dt, delta z become dz. Okay. So this expression involved means continuous. That means continuous distribution. It should be interpreted as a meaning that corresponding expression involved is very, very tiny. And the delta t approach to 0. I mean, very, very close. For this class, we define the dz versus dt just means continuous. Okay. So when we do continuous interpretation or the modelings, we can just using ordinary calculus. We don't worry about stochastic process. We don't need about jumps, because if you discrete, you have a jump situation. So basically, the ordinary calculus will be good. You don't need to really worry too much about stochastic process. It's a kind of a loose way to handle it. Mathematical, it's not strictly speaking, it's not true. But in our case, we just treat as if it's true. In real world, we find out, hourly, the difference between hourly and minute is so tiny. So it's if converged. If you take a limit, you converge to a continuous compounding, which gives us tremendous leeways when we do our calculus part. So here is the book. It showed you example. Now at first delta t, here's the partial t, delta t look like through time from 0 to cap t, right? Going up, going down. Now let's let the dt become tiny and tiny. Let's assuming this one is certain pattern. The measure is monthly. This one, the measure is weekly. This measure daily. So the last one showed you they let the delta t approach to 0. Then we have a continuous compounding. Okay. Now let's generalize. So Wiener process must have two part. One part is a drift term. A drift term is the average change, which is deterministic. Okay, a drift term equal to 0, and a variance equal to 1. So it follows a standard normal distribution with a mean 0 and a variance rate equal to 1. So, but that number can be changed. If you're not standard normal, we can change to A instead of 0. We can put a number in it, like a positive, negative, alpha, beta, to replace that. So a Wiener process is we say that the Wiener process have a drift term. Now this is the important equation. Equation 11.3 on page 219 is the key element in our today's study. So here is x, which is a random variable. It follows a generalized Wiener process with a drift term. The drift rate is alpha times dt. Now think about it's 1 day or 1 hour or whatever the dt is. A very tiny interval. So the alpha part is a constant, is a deterministic. Now second part is the b is a coefficient or beta times dz. Now dz is follow that the epsilon part, the epsilon delta dt part, which is random. Or we say that it has a deterministic part. It also has a random part. Now what is dz? It depends on chances. You let the computer throw the dice on for you. You'll get those numbers. In other words, the change of that random variable x has a predictable trend at alpha, but unpredictable at beta times dz. Now, we are using d represents continuous. Here is the discrete. In discrete, since when we do simulation of discrete, looking at every day, for example, change of x, the alpha times delta t, which is a deterministic, times beta times epsilon, delta, square root of dt, standard deviation dt. Okay, so here is the discrete form of a generalized Wiener process. All right. Now, it is not the stock price yet. In order to get that, we have to invoke another process called Ito's process by a Japanese mathematician. In an Ito process, the drift term is a function of time and variables. So here alpha, the drift term, itself become a function of x and the time. So are constantly changing. And the beta also is a function of time and the underlying asset. This is equation 11.4. So 11.4, this one is a continuous time, a continuous variable, continuous time, continuous variable. In discrete time, then we're looking at this one, delta x, is restated, but in the form of delta discrete time. In other words, the Ito process will allow us to calculate options. Later we'll show you that. Now, Ito process also used for stocks price. And that particular stock price is called geometric Brownian motion, or the Brown motion. Remember earlier we said people find, find no directions, zigzag, a dead pollen under the in the water, in the liquid, but it's a function of time. So 11.6 showed you the rate of return Now, if you see the ds means continuous time over s is equal to mu times dt. Now, in alpha here, we're using expected rate of return to be the parameter put in to the drift term. And the sigma is the parameter you put into the beta part. So 11.6 is for stock price movement. The stock price will move like this. Now 11.7 is discrete. How do we do the discrete? But everything will change to delta. The reason we're using discrete because at the simulation we have doing discrete. As I'll show you the discrete. So this 11.6 or 11.7 shows you how if you want to simulate stock market, basically will follow this process. And this process called Brownian motion. And geometric means compounding. It's a continuous compounding. It's a continuous compounding geometric Brownian motion. Okay? 11.6. Now, let me explain that in the discrete form, give you some kind of visual what those equation really means. Let's assuming a certainty world. In other words, sigma equal to 0. Now, let's look at this return versus time. Let's look at time situation. So on the vertical axis, we have rate of return, which is change of S over S, just rate of return, right? On the horizontal axis is time. From 0 to, let's say, how many years or how many days, whatever that is. Now, in this situation, since let's look at that geometric Brownian motion equation, change of S over S equal to rate of return equal to mu times dt. You don't have a second term. You don't have the sigma term because why? It's certainty equal to 0. That one's gone. In that case, we only have a mu, the long-term mu. So what is mu that really equal to? Since there is no risk, there is a certainty, no risk. The mu must equal to risk-free rate. We can argue, economic argue, during among the risk-free world, certainty world, the price for money, the exchange for money, interest rate, should equal to risk-free rate. Now, if risk-free rate is positive, we have this relationship. The rate of return will be straight line. So you see the rate of return, 1 day, 2 days, 3, you're compounding, going up. In a certainty world, going up. But we are not living in a certainty world. In the world, the sigma never be 0. Next slides, I'm going to show, just looking at the zigzag part, which describe a geometric and Brownian motion with sigma more than 1, or more than 0. So we have a risk part, second part. In this case, the mu, which expected value, should be higher than risk-free rate. Why? Because rational investor will demand high return to offset the risk they are taking. So in that case, the mu should be risk-adjusted discount rate or discount interest rate. It will be high, risk-adjusted interest rate. So you will see what you see is exact over the time horizon. I still post a straight line in it. We're assuming the risk-free rate, the appropriate discount rate should be higher than risk-free rate. So it still have upward trend, but the result depends on DZ. The textbook, let's look at the next textbook example. John Ho did a simulation, which is a much more complicated simulation, to simulate the generalized Wiener process or Brownian motion, a geometric Brownian motion. On the page 221, this is very good examples. Now, what you see in the market is this line. It's called the generalized Wiener process. This is the whole line. What you saw is just like, U.S. stock market from 1929 up to, no, I'm just kidding here. I'm just thinking, look like stock market going up. But how he generate those numbers? They have two parts. First part, there is alpha, the drift term. A drift term alpha is positive. So it's alpha times dt, upward slope. But second part is come from dz. The dz is the epsilon part. The error term can be up and can be down. It depends on a randomness. The one possible outcome look like this. You add the straight line with one possible path of the random line. You have the results of the simulation line. The result of geometric Brownian motion, in other words, have two parts. One part is the deterministic part. One part is the stochastic part. You combine these two together, what you saw is the stochastic part. It seems like a stochastic part. So, strictly speaking, U.S. stock market does not really follow its pure random walk, which will look like totally, is a random with expected value 0. That's not rational. In historic U.S. data, as we study investment class, showed you, small cap stock have a high average return, large standard deviation. Large cap stock have a relatively lower expected value, the average value, but smaller standard deviation. But we have some kind of a trade-off between expected value versus stocks, versus volatility, versus risk. So there's a long term. So you invest in stock market, there's a long term which are positive. Historically support that. In other words, I'm going to argue U.S. market have an alpha more than 0 over the long run. And empirical support that argument. Now, if you say the U.S. stock market is a pure random, the alpha equal to 0, then investing in Wall Street, investing in stock market is to go to play, in Las Vegas, become pure gambling. To be honest with you, gambling, the alpha is negative. The chances for you, average is going, you're losing money to the casinos, right? So for a rational stock market, the alpha must be positive. So the full term for U.S. stock market, what the simulation should be, it should be a random walk with a positive drift term, or a geometric Brownian follow a geometric Brownian motion with a positive drift term. Here the drift term give you 30%, which is kind of steep. Beta equal to 1.5, right? Beta equal to 1.5. This is just a simulation. Showed you. I really like this chart. I think it's very important to understand the stock movement. There are certain part you just cannot predict. There are certain part you might have some pattern. The long-term drift, the long-term, average return, positive. But certain term is pure random. Now let's go back to this, the distribution. Here we need to talking about is a normal distribution, the bell-shaped normal distribution. Equation 11.7 showed you a this is discrete, right? Delta S, discrete rate of return. Delta S equal to S1 minus S0 divided by S0. Delta return. This is rate of return, isn't it? Follow, let's assuming that the return is a very tiny one, okay? The period is a very tiny one. Approach like 0, okay? Time delta equal to 0, then we get a continuous. So a follow, delta means follow a distribution of a normal distribution. Oh, let me go back. Normal distribution. With the mean equal to mu times dt, the drift term. Standard deviation equal to sigma times delta dt. Now sigma, they always show this Brownian motion. It's a function of time. Okay. So this is the mean standard deviation look like this. Given that John Ho did a simulation, equation 11.1, they call it Monte Carlo simulation. Just, it's a type of just one way to do it. Just let computers throw the dice for you instead of, go to the casino, let's throw the dice. We'll do a sample random pass. Just try to let the computer throw the dice for you. The sampling coming from the epsilon part. The epsilon part is the random part, not the deterministic part. Because we know the mu part, expected value is 14%. Sigma equal to 20%. The change of times is 0.01. Now here, the book getting more specific. They're talking about trading days is 252 days, not 365. Because trading day matters, not the calendar years. But that's not that important for us for the time being. So delta 0.01 is close to 3 days, about 3 days. Right? About 3 days. We're just using a number, 0.01. So in this case, what we do is the change will be follow a standard normal distribution with a mean of 0.0014 standard deviation times whatever the computer has threw at you. The computer will throw at you. Here is how their simulation did it. Next page. Okay, change S. So the S1 minus S2 that you simulate has a drift term of, what is here? Okay, have a drift term of 0.0014 times S. S is the change of the stock price, the current stock price. So it's a rate of return on the stock price, current stock price, plus the error term. The sigma is 2% times S, today's current stock price, then times the random shock, epsilon. Okay. So you're looking at about 3 days, or 0.01 year, 3 days. Initially, it's $20. Using the formula 11.12, let the computer throw dice between 0 and 1, standard normal. One sample to give you 0.52, the epsilon equal to 0.5, pi 2. Plug 0.52, keep on moving back. 0.5 to that epsilon, equation 11.1. Then solving the equation, you get the change of S equal to 23 cents, 0.6 cents. So there's one sample based on whatever the dice threw at you, the random sample at you. So $20 plus the change in stock price, 23.6, you get a 20.236. Then let the computer throw again the epsilon. This time they give you 1.44. Plug 1.44 to equation 11.10. The delta S equal to 0.611. Add this to initial stock price 20.236, you have the new price 20.847. Let computer through the epsilon again from 0, 1. You get a negative 0.86. Plug that in to equation 11.10. The whole thing should be dropped by 30 to 33 cents in minus. So on the first column, you show you the stock price moving from the beginning every 3 days, up and down, up and down. It's really dependent on the random part. What we saw is, now remember this one do have a positive drift term. The mu long term, we interpret it as a long-term rate of return, is 14%. Right? For 3 days, not the exact rating for those numbers. But the random term take over. You see the result is a random. The result is a random. All right, Ito process. Now we also have another one, Ito's lemma. Ito's lemma, the best interpretation let's just read it. Okay, if we say that the stochastic process followed by X, Ito's lemma says that if there's a function, there's another variable which depends on X as the underlying asset, and also a time. This is called the Ito's lemma. Here, G, the good example, let's think about options. The option is a function of underlying asset stock S and time. But the underlying asset S here, the XS, follow a stochastic process. Then G, according to Ito's lemma, follow the following process. Ito's lemma basically arguing a derivative security is a function of a price of the underlying asset and time. It is an important role. Ito's lemma actually is a kind of approximation function to describe a variable which evolve its price change depending on another variable called Ito's lemma. Okay, we'll just go with that. Now here is the formal description of stock price, which is the underlying asset, and the function and option. Here is a G of S. Let's look at stock price. Stock price ds, here is a continuous time, right? ds is equal to mu, the expected value, long-term expected value, time S, time dz. Now this one equal to alpha time dt. Time value. So deterministic part. dt itself, just change of time, right? Very tiny, infinite small time interval. Deterministic part. Plus ds. ds is the variance rate, standard deviation time stock, time dz, which follow a standard normal distribution. Now here, you see that he moved on the left hand side, the change of stock price can be right ds over s, right? Divided by s. But let's move time s on both sides. SS cancel it out. We isolate ds equal to right hand side everything times s. So like 10% times stock is 100. Now it's 100. 10% times 100 equal to 10. Now this is the mu times s equal to $10, right? So sigma s, if the sigma is 20% per year, s is 100 here. Not the per year, whatever the period here for the per period. 20% times 100 equal to 20. Right. So this will become just a constant number to do it. In other words, this one is we called the Brownian motion, geometric Brownian motion, exactly geometric Brownian motion. Okay. Now for a function g, now think about option. Here is the option, which is a function of stock price and the time. Ito's lemma lets you say the drift term for this function g, for this variable, which depend on s, look like this. Partial g over partial s times mu s plus partial g over partial t plus 1/4 of partial square g divided by partial s squared times sigma 2 s2. The whole thing times dt. The whole thing in the bracket is the drift term for options, for g. And the next term, let's see, the random term part is partial g over partial s, now that we're using derivative, partial s, times sigma s dz. This is a random part. Now notice that what is the uncertainty part among these two equations? The uncertainty part is the dz. In other words, the risk source is coming from one random variable, not two. Okay, d1, the dz. What really causing dz is due to the nature of stock price. Whatever stock price it contains, some riskiness. And the option, its value change, is not dependent on its own risk, but dependent on the underlying asset risk. That is a very important concept, because later when we study Black-Scholes model, we're basically using the risk-free hedging. We hedge ourselves, let the DZ cancel each other out. Then we build a risk-free portfolio. Then we price in it. So here the argument DZ, the single risk source, is DZ only. That part nobody can control. This by definition is random, right? So all the rest of it they are all constant numbers. So all deterministic part. Well, I know those one are looking at it like dizzy, but you have to understand that to understand Black-Scholes model. Otherwise, it will be hard for you to looking at all Greeks. Okay, I need to move on. In this chapter, the section 11.7 is heavy duty. You have to go over with it. I'll just copy that. So they are arguing G equal to log S. The argument, it says S here, actually S is stock price, follow a log-normal distribution. A log-normal is not symmetrical like a normal. It's skewed to the left or to the right, depending on whatever that is. It's not symmetrical. But the algebraic speaking, you take logarithm of a log-normal random variable S. That G become normal distribution. Now, let's just plug in G is equal to log of stock price. It's the first order of a derivative with respect to S. If you're looking at a calculus book, you take a square root, you take the first order condition with respect to S. You get 1 over S. Second order condition, you get negative 1 over S0. You take G with respect to T. There is no T, so you have 0. With that, you plug those to our early example, 11.4. Inside the bracket, which showed you the first one, partial G over partial S equal to 1 over S. S cancel each other out, become 1. So the first term, you have mu. See that? Plus partial G over partial T, which equal to 0. This term is gone. 1/2. Now this one partial square over partial s squared, which is equal to negative 1 over square root 2. Square of 2, a square of s cancel each other out. What left is sigma squared divided by 2. So internal, the enchilada of this part is equal to, come on, mu minus sigma squared divided by 2. Now this is the mean, the alpha term, the mean term, the alpha term, plus sigma dz, because we know that partial g over partial s equal to 1 over s. S cancel each other. What left is d times dz. So you have that. So equation 11.17, which we're using in our next section for stock market, and is coming like that way. So has a mean of this variance sigma squared over t. Now, here is the argument, algebra argument. So if the random variable x is log-normally distributed, then logarithm x, the x itself is log-normal distribution, but the logarithm of that log-normal distributed x is normally distributed. Just take it, this is algebra rule, okay? The probability rule, I'm sorry. Now, the next one is algebra. In algebra, logarithm of a ratio x over y is exactly equal to log of x minus log of y. Now, this is algebra. Remember that, because later we were using this one to apply the derivation. So let's look at 11.18, what that is. On the left-hand side of the tilde is log st minus log f0. So what is that? That is exactly equal to log f st divided by s0, isn't it? Rate of return. But the first one is random variable. St is random variable. The second one is 0, is a constant. Today's price, $100. That's it. There's no uncertainty involved. So this one become a constant number. Now the right-hand side for a normal distribution give you a normal distribution, a shape, right? Bell shape. We add the mean by a constant number because this one is no uncertainty. It's a constant number, log of st, right? Log of 100 equal to 10, but put the 10 inside. You add that constant number to the mean, then you shift the distribution to the right. You shift the distribution to the right. The standard deviation part not change. The shape of distribution not change, but it's just scaled upwards. The whole mean moved to the right. So 11. So you see sometimes they are using the equation 11.19 in the fundamental book, chapter 13. Sometimes using the first one, you get confused. The reason is they put the log S0 inside as a mean part because it's a constant number. You can shift the constant number. Everybody add 10% to your final score. So the shape moved, but the distribution does not move. It's curved. People curve it using that. Now here, like briefly looking at a distribution of a log-normal distribution versus a normal distribution. Okay. I have a simulation attached with it, but for time limit reason, I really don't see the time when we can do it. It's basically you will see that a log-normal does not have a it's not symmetrical like the right-hand side normal, right? Now because we know how to dealing with normal situation because it's a symmetrical, so we can using the rules like 68, 95, 97, 99 rules. 1 standard deviation, 2 standard deviation. Today actually was more precise. It's not 2, it's 1.96 standard deviations, right? But log normal is skewed. Then why is stock price using log normal? It's due to the economic argument, limited liability. Why we're assuming a log distribution for stocks is because it's limit liability. So the maximum loss for a stock investor is negative 100. Losing all your money, that's it. Because it limit liability. But maximum gain can be 200, 300. So, it's slim. But so it has a truncated, a limited downside risk, but upside risk can be high. So it's unsymmetrical. So its mean, its mode, and its medium are not at the same place. But on the other hand, in normal, everything is in the middle. So log normal, because we think the stock price, because limit liability, we have to using log normal to distribute it. But luckily, we can using logarithm of the log normal, we get a normal distribution. So we have to dealing with using logs on the logarithm. So technically, we transform one distribution to another more manageable normal distribution. Up to now, actually, we will prepare you to do the following number crunching exercise. I post a detailed a step-by-step exercise for you to do it. You can click the sign that will give you. This is basically based on this. Example 13.1 from the current fundamental textbook. We are dealing with some kind of review of what we study in investment class. What is the confidence limit, upper bound, low bound, and what is the mean, what is the standard deviation or variance of future stock price. Now consider a stock with initial price $40. Expect rate of return 16% per annum. Expected value is 6%. Standard deviation 20%. From equation 13.2, that distribution function, the probability distribution for log ST, which is the future stock price at time maturity, cap T, will follow a normal distribution. Its a mean term is log S0, which is log 40. See, it's a constant number. Plus long-term mean 16% minus 20% to the power of 2, give you variance, divide by 2. The whole thing times, the whole thing bracket, times 6 months, 0.5. That whole thing is mean. Now what that one is equal to 3.756. And then what is the standard the variance and standard deviation term is it's a variance times 0.5, 0.02. Now, the log ST is normally distributed with a mean of 3.759 and a standard deviation of 0.02. Given that it is a normal distribution, we know that there's 95% or has within 1.96 standard deviation up or down. Now, in investment class, for the simplicity, I say that within 2 standard deviation, 2 is approximation. I round it up by 1.96 to 2. You can check the table that exactly the 2.5% up, 2% down within 95 confidence. It should be 1.96. That critical value is 1.96. Here we're using precise. Therefore, what we do here is we're using the mean 3.759 minus the 1.96, the critical value, times one standard deviation 0.141. 1.96 is the 2 part. That's the low bound, because the low value, the upper bound, is the mean value 3.759 plus 1.96 times 0.14. This is the upper bound. The in the middle is the log ST. Now this is a standard normal distribution. Not standard normal. It's normal distribution. It's normal distribution. It is standard normal distribution. That in this case, we are looking at log ST. But if we want what the ST would be, you want to ask, what give me like a 95% confidence interval? Tell me what the stock price, let's say a year from now, or 6 months from now, would be. We do a anti-log, or using E exponential. It's also called an anti-log. E to that one, what you have the following. The low bound, take E of that, is equal to $32.55. Upper bound, 56.56. In other words, 6 months, within 6 months. The stock price today is $40. It will be within the range of 32.55 up to 56.56, based on 95% confidence interval. In other words, roughly speaking, try 100 times 95 within that range. Right? So this is how do you calculate that. Now you need to do this exercise. There is an assignment. In my assignment, I also ask you to, given, for example, this, there is option, right? Call option, right? This on the stock, with its value is exercise value equal to 42. I ask you, what is the chances for this call will be in the money? In other words, what the chances for stock price higher than $42? The exercise showed you how that be done. That's my homework assignment for up to now, okay? That number, I call it number crunching problem, is based on example 13 point, whatever we did to the example is. We are using statistic, basically market generate statistics, expected value, standard deviation to calculate. This method is called actuary approach. Just like insurance, depending on actuary to calculate what the chances for a teenager between 18 to 22, chances to get a fatality. Based on empirical data, you calculate how many insurance policy you need to sell, what the chances those drivers might kill themselves, then what your payback will be. Those are, you calculate chances. That's why, because that age have a high probability, so that age group, you have a price higher, right? We are using, now, starting to using the tables, to look, checking the tables. But the table is not so exact. You have to do extrapolations. This is online courses. Let's using spreadsheet. Let's using spreadsheet to do the calculation. The calculation for standard normal distribution is, for current version, is norm STIS. The book using MORN, norm, and the DIST together without the S, but the latest version they changed it. I heard that they put some kind of dot in between those things. Am I getting, try to improving their approximation method, because those probability are also approximation. They improve the estimation. We are only be good at 4 digit after decimal, good enough. So no matter what that is, remember that formula is norm DST. Up to now, if you can do this after you study carefully my number crunching problem, okay, which is kind of challenging. Do problem 13.9 on page 318. Now consider this is something you will do it similar in your final. I pretty specific on this assignment, because this is basically using the distribution without relying on any specific model. We're not using Black-Scholes model yet, but give me empirical data. Just earlier I said that, like insurance, you need the actuary. You're looking at what happened, your customer, the accident. You need to calculate the probability. Now this one, exactly we do this. So please do spend some time on that problem 13.9. We're going to revisit this log normal distribution excuse me, in final, to show you understand what the dynamic really is. All right. So much for the first part of today's lecture.